Okay, let's talk about cash flow planning for investors. Okay, so when we're talking about investors, and my apologies, Rosa. So for everyone, remember, we are phones away. Phones away, Rosa, please.
Oh.
Thank you. You'll have your break shortly. Okay. So when we go, when we are talking about investors, there are two ways to make money. The first way is cash flow, right? If I rent it for $2,000 and my mortgage payment is $1,500, I make $500. Simple math. That is cash flow. Then there's appreciation, which is as you hold the property over time, then the home is going to appreciate. You're going to realize that equity.
I got a zinger real quick.
Yeah.
You know how it's always, oh yeah, in Hawaii, property values double typically in 20 years, blah, 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 right? Mm-hmm. So if you were to do your mortgage with the insurance, then typically by the end of it, you'd pay about double what you paid for your house because of all the fees and everything like that. So if you're supposed to double your home value, but you also pay double for your home value to pay off a mortgage, they basically even out.
Well, so a couple of different things. Okay, so
that's basically a
so what I can say is that's definitely not the case. The reason for that, and we'll cover it a little bit in today, but also in taxation, right, is the mortgage interest is a tax write-off, and that's the difference. Is that when you're, and we always like to say it in the housing industry, right? Whose mortgage are you going to pay? Your own mortgage or your landlord's mortgage, but somebody's mortgage and somebody's house is getting paid off. It's either yours or somebody else's.
So also to just piggyback on that, the depreciation, if you do have it as an income property or whatnot, then technically over 27.5 years you would get that back in tax savings. However, a lot of people don't necessarily, I don't know, whatever their situation, a lot of people don't rent out their house or a room in their house or part of their house, so they can't necessarily get that depreciation credit.
So that's on primary residences, but when it's in an investment space, it's going to be a little bit different.
Right, that's what I'm saying,
Yep. And then depending upon how you run your taxes, you can either be in all red, right, which some folks like to do, which then means that they make zero. I've actually seen tax returns where they make zero. Or below zero. Actually, I saw some tax returns from a commercial investor. It was negative 544. Negative $544,000. Can you imagine what his refund was? And this guy was making multi-million dollars every single year. He was probably in a tax bracket of making like $15 million a year. So depending upon who does your taxes and who your advisor is, you can get very, very different results, right? So that's why we always say, if you are an investor, you definitely do not want to be going to H&R Block in order to get your stuff done. They're great, but they also have less sophisticated folks working for them than, say, someone that's a true CPA running their own business, having done it for many, many years. Because just like anything else legal, you're going to have those loopholes, and it's the experience over time that shows you and teaches you those loopholes so that you can, in fact, work within them and use them to your advantage. Yep.
So with an investor like that, if like say that they had, you know, like they went to buy a house and they needed to claim on their taxes so much income, then they could have used that negative 450 to get a credit technically on whatever they owed for the last 2 years, I believe.
What do you mean by
so
that?
Like say that, you know, you do your taxes and you claim a bunch of income, right? You have to pay 30% if you take deductions, blah, 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 blah. So let's just say that somebody owes $50,000 for 1 year, $50,000 for another year. That's $100,000 in 2 years that they would owe because they filed their taxes and they claimed that income, right? So they got on a payment plan, or, you know, they said, okay, they're going to pay. So then they did their taxes in the third year. They say had a negative income of the $100,000. Then that would technically cancel each other out, but you're only allowed to do it for, like, back do it for 2 years. Yeah.
That's correct.
Yeah. You are right. In those cases, though, we didn't need the gentleman's tax returns at all. We just did a stated income investor loan, and then that way you can get around all of those things. And when you are using tax returns, that's going to be qualifying conventionally. But like we said, there's a ton of investor programs that we could use too. But thank you, Ashley, for that.
I just want to share that I think we all know in Hawaii it's hard, but yeah, most of the clients I've managed properties for are barely cash flowing. So it's really hard.
Yes,
Why isn't
and we're
equity
going to see
stated
some of
why?
those exhibits. Yep,
Yeah.
we're going to cover that in a little bit. Okay, buying property in an LLC. So when we purchase property in an LLC, that means that you are creating a legal entity that is going to then be the owner of your property. LLC stands for what?
Limited liability company.
Perfect. Limited liability company or corporation, as some people like to say it. The reality of it is that is reserved for investors. Okay. When we have an LLC and we are purchasing property in an LLC, traditional conventional mortgages will not allow you to take on title as an LLC. Can anybody think of why?
Because
Well,
I mean, the
If they're-
LLC is not a person.
yeah,
That's
if
right.
exactly.
Yeah.
Right. So when people develop an LLC and they place their property in its ownership, basically what they're doing is trying to change the liability from themselves as a person into something, into an entity, like you said, Storms. And what that does is that limits their liability. Does a mortgage company want to give you $1 million and then say, we barely even care if you qualify for it, or we barely even care if you guarantee it?
before they did.
Well, couldn't the mortgage be held by the private person and the title be changed over to the LLC?
It can, but let's answer this question first and then we'll hit that one. So as far as a person being able to qualify for that, leave her alone. You're fine, Ashley. But anyway, so when a person transfers ownership in an LLC, they're trying to remove the debt or the liability or the obligation from themselves. So if the property goes into foreclosure, they want to say, I didn't do anything. My company did it all, right? But that's not the way that the lenders want to see it. They want someone on the hook. With everything that lenders do, obviously, it's to help home ownership. But why would we be lending money if the risk was too high, right? And the worst case scenario for something happening when we lend out the money is going to be somebody not paying. So when you place your property into an LLC, what you're saying is, maybe I'll pay, maybe I won't pay, maybe my company will pay, maybe it won't pay. You know, it's a 50-50 shot, right? Let's see what happens. So with that being said, to answer her question first, then we'll get to you. If you place your property into an LLC after closing, the lender is going to get a ticket that says that you did that. And that's where this due on sale clause comes in, okay? If you did not get it approved ahead of time, which would make you ineligible for a conventional mortgage, then in that event, they do not want to, they will call you forward and accelerate your loan. And what that means is if you borrow $1 million and they figure out that you sent it into an LLC without their authorization, then basically what's going to happen is you're going to get a letter that says, we know that you made an illegal transfer. This was not part of your mortgage statement that you signed or your note that you signed. And because of that now, we'd like our $1 million back. You have that 30 days to give it to us. You can either sell your home, you can refinance it, we don't care what you do, but give us the $1 million, right? You're not being truthful to us.
That's why the mortgage note is to the person and the title is to the LLC.
That's only on a portfolio loan, so we'll get to that. So if you are purchasing in an LLC, it's gotta be a portfolio loan. Fannie Mae, Freddie Mac, obviously are not going to touch it, and then any government loan is only for owner occupied, it's not for an investor. So you don't have that opportunity with Ginnie Mae. But when you're working with Fannie Mae or Freddie Mac, they will not approve that loan. It has to be 100% the person on the hook. If you go for a portfolio loan though, who knows what a portfolio loan is?
State and local, the bank.
Yeah, that's what that means, is that the bank, got somebody after me here, that the bank is lending their own money, number one, and that they're keeping it in their portfolio. They're not transferring the rights or the loan itself for servicing to anywhere else, and they're making that distinction by keeping it in their portfolio. But in exchange for that, your interest rate's going to be higher, right? Your down payment contribution is going to be higher. So there's a lot of incentivification for fraud surrounding that, right? And we've all had that in this room. When you're like, hey, Mr. and Mrs. Homebuyer, are you buying this home to live in it? Or are you buying this home to invest in it and you're not going to live it? What do they say? Which one's better? They don't want to tell you the truth. They want to tell you what you want to hear. They want to tell you what they think will get them the best scenario, right? And my take on that is always, well, it's got to be true because they're going to find out, and then they're going to call the debt forward and you're going to be without a house. So you got to tell me exactly what it is, because if there's any kind of a problem after closing, like we get a ticket back that says that there was a title change into an LLC, there was a title change on a straw buyer. Who knows what a straw buyer is? That is when you get somebody else to qualify for the loan for you, right? I can't buy the house. I've got judgments, divorces, problems, whatever my problem may be. So I'm going to get Joe to get the house for me because he's my bestie or my boyfriend or whatever it is. And then as soon as he gets on title and qualifies for the loan, he's going to give it to me. Okay, that's called a straw buyer. That also is illegal. And if the mail starts getting returned, if they, see any kind of indication that you've made any of these illegal transfers or been involved in some kind of fraudulent activity, they will send someone to the house to knock on the door and find out who's inside. And if your tenant opens it up and says, oh no, the owner hasn't been here since I started renting the property 6 months ago, guess what? You're not owner occupying and meeting up to your mortgage requirements, and then that will cause a problem. And then, and now with these investor loans, same thing. If you can get into investor loan with no income qualification and all of that stuff, what does that make somebody that can't qualify for their own house want to do? Say that it's an investment property, right? That way they can use an investor solution, DSCR, whatever the case may be, and then they can get in without qualifying for the home. Why? But the investor solutions are adamant. When you go to closing, they have you sign all kinds of paperwork that says that you will not occupy that property and you will not put any of your family members into it. Okay? Why would a bank that's doing an investor loan care if you're living in it as your primary residence?
It's not generating income.
Yeah.
Number one, it's not generating income, but the other part of that is that when you go to court for foreclosure and they bring that mortgage statement with them, who do you think is harder to kick out of the house? Somebody that's living in there with their babies, or somebody that's just renting the property out? An investor is always going to be viewed by the courts as less dominant per se, or has less of a case for foreclosure and things than for an owner occupant, right? If you are occupying the home as your primary residence, there's a lot of, especially after mortgage meltdown, there's a ton of legislation surrounding all of that to protect you, right? Hope for homeowners, forbearance. How many people took the forbearance during COVID, right? What do you think those people said as soon as the mortgage payment started back up?
Oops.
Yeah, they didn't know.
I didn't know I was going to have to pay it later. What do you mean the money didn't, got tacked on to my mortgage payment? I thought that the government was just making my mortgage payments the whole time, right? Okay, so that's the kind of stuff that happens with primary homeowners. And because of that, that's going to be a problem. So whenever they write a business or investment loan, they're adamant to make sure that you're signing paperwork that says that you were never going to move in there. That way, if you do have to go to court and talk about it, they'll be like, hey, mister, you signed this document, which says that you did commit fraud when you signed this document. You're in trouble, not us. Get out, right? But it's not about that. It's about that when people buy homes and they're taking on mortgages, they're asking for an investment partner. And then after they get the keys, how would you feel if your partner came back to screw you, right? Not very fair. And that's really what it's about. Go ahead.
Two thoughts.
Sure.
Two separate thoughts. Okay, so the first one is if they bought it as an investment property, they can actually live in 2 years later and make it an owner occupant.
12 months. 12 months.
12 months. So that's one thought.
Yeah.
The other thought is, are you able to speak to the new law where all LLCs need to register with FICIN?
With FinCEN? Yeah. So as far as all LLCs needing to register, so here in Hawaii, we've actually got a registration process already. Many of you have probably gone on the DCCA website to check out the articles of incorporation and all of that stuff. But yeah, all LLCs should be registered. It's just that some of them are flying underneath the radar. So it really just depends on, whether their CPA is checking it for them or whether they are in fact just following the law,
Would that impact, do you know it? Well, I guess it's so new, right? We don't even have any longevity study, right, in terms of the negativity or how it affected the business owner, right?
Yep.
But you get fined if you don't file for it.
Yeah, exactly. And they'll come back and retroactively work through that stuff too. Meaning that, let's say that you developed an LLC, 10 years ago, but you didn't really do anything with it and it didn't really make any money, and so you weren't really filing your LLC tax returns. The state of Hawaii or federal will actually send you a notice that says, hey, you didn't file any income, but we thought you made about this much and you owe about this much based upon our calculations in your past history and things like that. So there are ways to retroactively go back and kind of force you to pay some of that stuff even though you haven't filed appropriately.
Kind of piggybacking off of the first thing you said. If in your example, if somebody came to knock on the door and a tenant answered and was like, oh yeah, the seller, the landlord hasn't been here, since I moved in or whatever, but the landlord is able to prove that they lived there for at least 6 months and 1 day, would that still be fraud?
That is still fraud because the mortgage statement that you sign says that you're going to be there for 12 months.
Oh, it's 12 months specifically, not the majority of the year.
No, it's 12 months specifically, it says.
Got it.
And, but, right, there could be extenuating circumstances.
Like deployment and things like that.
So if you're military, you could, there's a great case for that, but you would also have to show your orders.
Right.
So the reality of it is when it comes to occupancy fraud and all that stuff is, it's just gotta be true.
Yeah.
Okay? So if it really, really happened, then you won't have any problems, providing that documentation. That happens all the time. Like somebody will say, well, maybe I can say that my dad died. Okay, well, did he?
Death certificate?
Do you have a death certificate? Right? Oh, well, he was really sick. Okay, well, that's not the same.
Yeah.
So things like that, right? So if it is true, then you're going to have to bring in the supporting documentation. They're just not going to take your word for it. Because the reality of it is whatever you think that you're going to try, we've been writing mortgages for like almost 80 years, right? So somebody else has already tried it. It's like when your kids are trying to be rotten and they're like, I'm gonna be so smart with mom. It's like your other brothers did it already. Or better yet, I did that stuff in college, so I know what's going on, So, but you can only get away with it if it's novel, right? But most of the time it's not novel. Most of the time somebody has already tried it and we've got guidelines in place, and that's why they have the guidelines that they have. Because somebody has tried it already.
Got it.
Yeah. Okay, that's LLC. All right, IRA. Now, when you have an IRA and the IRA, remember, is held by another entity. So let's say that it's held by Charles Schwab, okay? So you can then work with Charles Schwab. There's a few different facilitators, so everybody in this room, for the most part, understands how a 1031 exchange works, right? You've got your facilitator that handles all of that stuff. So same with an IRA purchase, you will have a facilitator. Sometimes it's inside the company that you're working with, and sometimes it's an outside facilitator, okay? But what happens is, let's say that you've been socking away money in your IRA and you've got $1 million in there, okay? You can work with your facilitator, and we don't offer IRA transactions. There's only a couple of companies that do it. IRAlending.com does it, although last time I checked their website it wasn't even working. But there's a few different facilitators that do it. They are becoming a little bit more popular, but number one, it's for investment property only. So folks will say, well, I'm going to use my IRA to buy myself my new house. Well, you got to put a tenant in it. You can't move into it. It's for investment property only. The IRA holds the mortgage. So once again, kind of like the LLC, concept, the IRA is the holder of the mortgage, not you. And then the loan must be no recourse. So meaning that in the event that there's some kind of a foreclosure action, that it will the government will not come after the individual. They will come after the value in that IRA. So your IRA is basically acting as collateral for your mortgage. And if you had $1 million in there, it is kind of like a dollar for dollar exchange. So you could use that $1 million to buy $1 million home.
Is that? Oh, sorry. Yeah.
Yeah.
How's the taxes work? How's the taxes work? I don't know, I guess.
So the taxes for the IRA, so technically there's no true money exchanging hands, because when you look at your IRA balance, it is still the same as it was. It's all in this facilitation company that's working through all of that. So there's no true like tax, implications to you. And Rosa, you used to work for the IRA and for the IRS. Can you answer that question for him?
I can tell you what Kat told me.
There's no as far as I know, there's no tax implication, but the facilitation company is dealing with all of that. But you're keeping your IRA, and then you've got your property. If your property ever goes into foreclosure, they just take the IRA monies in order to pay for them.
Can he sell?
Can you sell?
Yeah.
You can sell.
Oh,
Yeah, yeah, you can sell. Mm-hmm.
So Kat was telling me something about how when people buy with, their self-directed IRAs, they buy property, then there was something like some kind of a fee, a penalty was what it was, not like a tax thing, it was a penalty. And then if you were to go ahead and say you buy in cash with your IRA, quote unquote, then you go ahead and acquire the property. If you were to do a HELOC, since it has 100% equity, and then pay that back within, I think she said 60 days, then they waive that penalty if you replace the money back.
Well, that's on an IRA withdrawal. So so those are going to become two completely different concepts than what we're talking about right now.
Oh.
So what you're talking about is when someone is withdrawing from their either IRA, self-directed or non, as well as your 401k many times. Okay, but the first thing that you want to know is that the guidelines are not always cut and dry. It depends on your provider and it depends on your plan, right? There's a lot of retirement plans that you can't even touch it until you're dead. It literally says on the thing, like, unless you quit the job or you die, you're not allowed to access the money, okay? But for your IRA, if you take a withdrawal, you do have a window in order to give the money back. So a perfect example is, let's say that, like you said, that you do take you need $100,000 to close. So you hit your IRA, but you know that your mom's going to gift you $100,000 in a couple of months as soon as she does what she needs to do, and then you're going to take that money and give it back. Or you can go out and get a home equity line of credit and use that money to pay it back. But it's really about borrowing from the IRA is what you're doing. And then based upon the rules, you have a window that you can work within.
So if we do it the way Ashley said it, the withdrawal way, you could actually do it for a primary residence.
Yeah, you could do it for primary residence as well if you're doing the
this
withdrawal.
This way is called just buying with IRA?
No, so what she's referring to is just basically borrowing the money for 60 days in order to use it as a down payment.
Yeah, withdrawal. Yeah. Or just
So this is using the monies inside your IRA to secure and provide as collateral for that home that you're purchasing. So those are two completely different things.
And can you do Roth? Roth, right?
I think you can do it on a Roth. I don't know. Well, I'm going to say once again that you got to defer to the experts on that. So, but as long as it is an IRA, I believe that you can do it whether it's a traditional IRA or whether it's a Roth IRA. Generally the Roth is after tax, so many times you don't have the girth in the Roth IRA as you have in a regular IRA.
Do you have to wait after a certain age if you want to sell it?
I don't think so. But the difference is, remember, when the IRA buys the property, if you do sell it, you're not pocketing the money.
Right.
It's going back into the IRA.
Okay.
Okay.
Yeah.
That's how we're like, we have a client, and that's how we're at this class, because we have a client that bought it with their IRA, and it's under the IRA's name, the property.
Yep.
So we're just trying to figure out, okay,
If he sells it, the money will just go back into the IRA. If you take the money out and then it stays out past the 60 days, you're going to get taxed on it based upon your income category.
So it's not a capital gains tax, it's based on your income level?
Is it like an
It
income
would be based
tax?
on your income level because all tax obligation is based on your bracket.
So it's not
And that
a
shows as
loan,
income.
It's a withdrawal.
It is a collateralized movement. It's not a withdrawal because the money is not going to the individual. Okay? If you do that, then you will have the penalties.
But then on your taxes, it's charged as income.
No, not if you're doing an IRA
Back
purchase.
into the IRA.
Because as an individual, you're not getting any money at all.
When you withdraw, is it as income?
Yes, when you withdraw, it's considered income.
Makes sense. Makes sense.
Yep. So just think about it this way. If you take the money from the IRA and it bypasses you and goes to something else, then the individual gets skipped, right? So once again, that liability issue, which is why very few lenders want to do this type of transaction. But if you are taking a withdrawal and the money's going from the IRA to you, it's going to be your income. Because that's what it originally was anyway, right? It was your paycheck money that you took and put somewhere for savings, but you got to do it pre-tax because of this entity, this word, and this company, right? So, but if the money is bypassing you and going straight to the property, the IRA owns the property and nothing happens to this individual. But if the money comes here, then you will pay it as income because it was realized income that you just took. Because you spent the money on something else,
And it wasn't
Alexis,
taxed
or
already.
whatever.
Yeah.
And then same thing, if you sell the property, so the IRA holds it, and you sell the property and you're like, you know what, I want the money to go to me, then you're gonna pay all the taxes. But if you put it back to the IRA, then you're basically in the same space.
What about the equity on top of that?
It just goes back to the IRA.
So you'll give them the,
Yes.
It's only
Yes.
for your
There is no way to because once again, if a penny comes to you, you're paying taxes on that.
your client's retirement.
But that's why they do that, right?
To avoid the
To avoid the taxes.
That's pretty cool.
Yeah. Yeah.
I was never told about this.
All right. NOI, net operating
We weren't
income.
told friends yet.
Okay, net operating income. So this is a commercial term for the most part, okay? Unless you are getting into, and we'll talk about it a little bit when we get into condotels and things like that. But net operating income basically is the annual net cash flow of property after deducting the operating expenses, but before deducting the mortgage payments. So when we are dealing with NOI or net operating income, that is technically the component of the DSCR loan that we just talked about, okay? And an example of that would be, I bought this unit in wherever. It is $3,000 a month mortgage payment. I'm going to rent it for $3,000 a month, so my net operating income is covering the mortgage, and we call that a 1-to-1 ratio. Okay, if you are making a profit, let's say that your mortgage payment is $3,000, but you're renting it for $4,000. Now you're operating at a 1.25 debt service coverage ratio. Okay, the higher the NOI, the more positive you're going to look when it comes to investors and ultimately the bank who are lending on your commercial property. When the banks are lending on commercial property, they will not take into consideration the merit of the borrower themselves or the buyer. They're going to be looking at how much income that property is going to be generating. And based upon that, they're going to reverse engineer it into the down payment contribution that you need to make. Because the lender never wants to be in a situation where you're not at least close to breaking even. Otherwise, if you continue in a loss setting, how long is that investment going to work? It's as long as you've got savings in your bank, right? And as soon as that runs out, you're not going to have anything else. And the reality of it is, and especially since COVID, commercial properties are not appreciating that well. In fact, they took a hammering during COVID, and they're still taking a hammering. So there's been a lot of commercial property exchange, and much of it is very cheap right now, especially here in Hawaii because our buildings are so old and the maintenance is so high. So that really feeds into your operating expenses, right? So when they take a look at your NOI, they're going to look at your gross rental income. They're going to look at any expenses that you have, and then that's going to give you your net operating income. And based upon that, we're going to reverse engineer it into a mortgage. Commercial loans, for the most part, are about 25% down if the NOI is there, okay? If it is not there and you're operating at a lower net operating income, then they're going to ask for more down payment. So then it's going to grow from 25% to 40% to 50%. So sometimes when you're speaking with an investor, they may say, well, you know, my friend got a commercial loan at 25% down. Why do I have to come up with 50% down? Well, you're going to say, well, look at your building. Look at the occupancy ratio. His building is full of users, right? He's got doctors on one floor, dentists on another floor. Every single suite is rented out. You've got 100 units and, 30 of them are empty. So how are we going to make up that income? So that's the way that works. Okay, so when we take a look at annual mortgage payments, we're going to be looking at the net operating income and then any cash flow based upon the space from there. Okay, everybody, welcome back. We're going to get into the math section now of the investor calculations. Okay, and then, so what I did was I went ahead and put these calculations that you just see on the board. And hopefully you can read these, but this says NOI, right? Net operating income divided by property value equals the cap rate, so that's number one. Then we've got the property value times the cap rate equals the NOI. And then we've got the NOI divided by the cap rate equals the property value, okay? So we're gonna use these calculations going forward, and in the event that you cannot read these, you'll also know why I had to stop being a school teacher and get into mortgages. So, okay, so these are the calculations that we're going to be looking at, and this is what we were talking about when we were saying, how is it that we're using the NOI, sorry, I'm standing in front of it now, but how are we using the NOI and the cap rate to calculate property value? Because when you are helping your client to offer on commercial property, you're going to be using these calculations in order to figure out what to offer for them, right? Go ahead.
When you define property value, are we looking at market value or assessed value? Or
You're looking at sales price.
sales price.
Mm-hmm. Sales price. So, and especially when it comes to commercial property, you could very well be buying it well below value, especially if the property has a terrible NOI, right? Because that's going to be your pitch back to the seller. Because obviously, number one, what do you know about the seller if he's got a terrible cap rate and a terrible NOI? What do you know about him?
You're not making money.
Not only is he not making money, he's about to go bankrupt. He's probably bleeding at the tune of $100,000 a month or something, right?
Insurance.
Yeah, exactly. So what you know about a building that is having a really hard time is that seller is on the verge of losing a lot. And for that, he's going to do anything that he can to offload it to somebody else and make it their problem, okay? Because just like what happens with condominium buildings, when you have a plumbing problem in your house and as a single-family residence, how much does it cost you to fix your plumbing? 10 grand, right?
Yeah.
How much does it cost if you have a building with 100 units in it? $30 million.
Yeah.
Right? So that's why all of the projects have assessments, right? That's why every project has an assessment right now. What happens to the maintenance fees when you have projects that you need to fix?
They go up.
They go up, right? So that's why every building pretty much across the all of state of Hawaii has cash assessments right now, and they also have maintenance fee increases. Who knows what the maintenance fee in commercial world is called? Starts with a C.
Oh, CAM, the common area maintenance.
Yes, it's called CAM. Mm-hmm. Yeah. So when we are dealing with residential property, it's going to be maintenance fees. When we are dealing with commercial properties, it's going to be CAM. And same thing, if you've got a building like this and your plumbing goes bad, somebody's got to come up with $30 million, right? And so when you've got a property that somebody's trying to sell, then what the real estate agent is always going to do is look at how it's operating, what the upcoming maintenance costs are, and reverse that and what the current cap rate is, and then reverse that into how much am I going to offer you, okay? You may want, $18 million for this property, but based upon how it's operating, I'm only going to give you 8 because I know you put yourself in a situation where you're losing money every single month, but why would I want to buy into that, right? Because I've got to get users, I've got to fill every single one of these rooms, and on top of that, I've got to come up with the cash in order to pay you. So that's going to affect your property value. And we see that in a residential scale right now. What happens when a property comes up and you've got an assessment? What does the buyer say?
Well, I want to take that off the sales price.
Yes. Who's going to pay the assessment?
The seller.
The seller, right? So same exact concept, but just in a commercial space, okay? All right. So when we are solving for capitalization rate, which is basically how much, overall percentage and profit that you are making, right? Higher the cap rate, better the deal, right? Lower the cap rate, lower profit, lower deal. So if we've got $100,000 NOI, which is your net operating income, and we divide that by $1 million, that's your property value, that's going to give you a 10% cap rate. Is a 10% cap rate good?
Yeah.
It's pretty good.
Anything
okay?
above 6, 7, yeah.
Yep, exactly. Anything above the mid-range, you're looking pretty good. Okay, now, if you're solving for NOI, which is your net operating income, you're going to take the $500,000, so your property value, times whatever your cap rate is, and then that should give you your NOI. Okay? And then same thing, reversing that. If we're solving for the property value, we're going to take the $25,000 in NOI, your net operating income. We're going to divide that by your cap rate, and that should give you your property value. So that's why when you are a real estate agent and you are going head to head with seller's agent, you're going to tell them, hey, look, man, I did the calculation. Based on your current NOI, your building is half empty, right? Your maintenance costs are skyrocketing. Your 10% cap rate, I'm not going to pay you what you want for this. I'm only going to pay you what it's worth. So going back to what you said, that could be, if it's a very desirable place, it could be great, fetching a great sales price. Or unlike residential property, it could be a great building, but because of vacancies and problems or what have you, it could be sold well below the tax assessed value. So regardless of what the appraisal comes in. So it's very possible for you to, based upon these calculations, pick up a $18 million property at $10 million because it's just not doing well as far as operating goes. But the reality of it is that investor is going to want to offload at anything that they can and write off the losses on their taxes rather than every single month eat ramen, right? And freaking out about what's going on at their building, because because each of those units, those buildings, all of that stuff has huge cams. Somebody is paying for all of that maintenance to keep the buildings open for the users that are in that building, right? You just can't say, well, I've only got 2 tenants on floor 2, so I'm just going to stop, bringing water in, right? I'm just going to stop allowing them to use the bathroom. Like, you cannot do that, right? You've got to keep everything running so that no matter what floor they go to, their customers don't see all the negative things that are occurring, okay? So that's how you can use these concepts in order to underbid the property or overbid that property if it is worth more and you want to pay a little bit more because it's super desirable. Okay, so cap rate number 1. So we've got a list price, okay, of $325. So let's try to do this together. We've got a list price of $325. So what's that going to be? PD, right? Okay. And then we've got $2,000 a month of rental income. But when we deal with NOI and we deal with cap rates and things, do we use a monthly figure?
No.
We use an annual figure. So what we do know is it's 24 months, right?
Yeah.
and this is going to be your NOI. Or actually, that's not going to be. That's going to be your income. Sorry.
12 months, but 24,000.
Yeah.
12 months.
12
Yeah.
months.
Yeah,
2 months. 2,000.
12,000. Yeah.
12 times 2 is 24.
Yeah.
For 24.
Yeah. And then so this is going to be your income.
Yeah.
Okay. And then we've got the monthly expenses. So what's 650 times 12?
7,800.
Okay. So 7,800 is going to be your expenses. Okay. So what do we got? Monthly NOI is going to be 1,350. And then if we multiply that by 12, what's that number? Somebody grab a calculator.
16,200.
Okay, so 1,350 times 12, 16,000 what?
200.
200. Okay,
Now let's get the cap rate.
so that's if I take this number, so there we go, 16,200. Good job, Riley. And if the going cap rate is 5.5, or I'm sorry, if the cap rate that it's performing at is 4.98, but the going cap rate in the neighborhood is 5.5. So what you know walking into this, okay, is that if you can get this property to perform, you can actually make a little bit of money, right? But you got to get users in there, you got to do all that stuff that you need to do. So when they reverse engineer this into how much they would want to pay, they're going to say, I'm not going to give you $325 because you're currently performing at 4.98. I will pay $294,500. But the reason why I'm going to buy into this loss per se is because with my new management, I'm going to make more money. Okay, so that's kind of the idea behind commercial real estate. Okay, cap rate example number 2. Okay, we have our PV, which is going to be $295. Then we're going to have our monthly rental income. So income is going to be what, 1,600 times 12?
Oh,
19.2.
Okay. And then we've got expenses are going to be 475 times 12?
5,700.
kind of low are the month expenses.
Yeah, these are mainline numbers, and it's just math.
It technically wouldn't have to be commercial property, any income property, any
I know,
income producing
she's
property
using
now.
commercial as an example.
Well, you figure for anything more than 4 units in an apartment building is commercial, right?
And that could be in a
Yeah.
single family home
So,
too,
and
yeah.
it's going to be that
I
kind
know,
of.
but the expenses is low.
Yeah.
Well, this is-
So remember,
Why you're-
this is a mainline presentation.
Oh,
Yeah.
Okay.
And they want to minimize the amounts of zeros that we need to put on the board. So, because if this number was 29,500,000, these numbers would be larger. So this is just giving you the examples of how the math works. But these are mainline presentations. So the expenses can be low and the list prices can be low too, which is why a lot of investors are actually preferring to go outside of Hawaii and invest. That's actually one of the great things about PRMG is that we are nationwide. So what will happen is we've got a lot of folks cashing out on their property in Hawaii, and instead of buying a condo in Hawaii, and we'll go through some of that stuff of why not, they'll take it to Georgia and buy like an entire development.
Like our firemen.
I'm glad you said that because I'll hit you up because we've been buying properties in the Midwest.
Yeah, Midwest, like Idaho. I've got an investor that loves Idaho, Iowa, and then some of the properties that come across. In fact, right now, I've got a guy that is selling in Makiki $490 for his unit. And he's taking that $490, he's going to Florida, and when I saw that house, I was like, I'm moving to Florida. Just this unbelievable home. Their pool, it's in a community complex, a single family in a community complex, much like you might see it like the Peninsula or something like that. And they have like this wraparound marina thing. And then inside the pool, this marina pool entity thing, I actually had to zoom in and say, what the hell is that?
Alligator.
Because I'd never even seen it before. No, it was picnic tables with grills on them, on floaties inside the pool. So now instead of grilling next to the pool and then eating at your picnic table, you can actually sit in the water in this inflatable grill thing. During the break, I'll show you guys the pictures. But I didn't even know what it was. I was like, looks like a spaceship, you know? But yeah, it was in water grills, so you could just bring out your little meat and like little hibachi right there, and then but you're in the water. Super cool. It's like a swim up bar, except like a picnic table, if you can imagine it. So very cool. But yeah, so a lot of folks are bringing their money to the mainland because then you can buy it in cash too. That's the other thing, right? You cash out $500,000 over here, you can go buy 3 properties in Idaho. Yeah, anywhere.
They used to
All
only
50
be able to do
states.
48 states, now 50, yeah.
Mhm.
Yeah.
Because we just opened New York.
Yeah, you.
Yep. Yep. So, yeah. So back to this. We've got the $295 purchase price. We've got the monthly rental income, the monthly expenses. Okay. So your NOI monthly is $1125, but the annual is $13. NOI is going to be $13,500. And let's say they're operating at 4.57. So does anybody know where the cap rate comes out? How do you figure out the cap rate? Or where the cap rate is published for the neighborhood, where it says going neighborhood cap rate?
Oh, no, I don't know where that's published.
So the appraiser, number one, the appraiser is going to tell you what it's operating at. So just like right now, and then let's bring it back to residential a little bit. When you have a residential property and you're buying an investment residential property, the buyer will order a investment appraisal, right? And there's one form, so that's a 1004. That's the name of the form. And then you also order a 1007 form. What's a 1007 form? Investment property, appraisal. What's a 1007 form? The
Like
rent
the cost-
schedule. The rent schedule. And the appraiser is not only going to tell you what the value of the property is, but he's going to tell you what the rent in that neighborhood is, right? How does he get that information?
Estoppel certificate, is that correct?
This, I don't know about that. But what I do know is that he's going to perform very scientific calculations, like looking in Craigslist, right? Looking on High Central, going back to some of those rental databases that you can tap into as a real estate agent in order to get that information in what everything is renting for. Now, when you've got a building, right? The easiest way is if I'm renting unit 202, what's unit 203 renting at, right? That's going to be super easy. When it comes to single family residences, it's going to be the rental in that arena and in that area. So when we order an investment appraisal, we'll get the value, and then we're also going to get what it rents at, and then that's going to dictate your transaction.
So you know how in real estate we have to compare against what's been sold, or typically when we do rental comps, we do it with what's already been rented, right? So would an appraiser do it based on what's already been rented? Because when you say Craigslist, those are active.
Yeah. So it would be both. So
Really?
it's So he will take into
But the active are
consideration.
subject to change.
Yeah, but that's what the going rate is. And the reality of it is when you are looking at what's already rented, just like sales, there could be somebody that's got their sister in it, right? That's charging them half the price. So his goal is to take a look at the whole scenario and see what also is trending.
Yeah, I had a phone call from an appraiser this morning.
Oh.
He's looking at the pending sales for my
So another appraiser
Right, 'cause
called me
it's a
about pending
trending,
sales,
right?
and I was so like,
'Cause they-
how are you doing this?
Yeah, they put it all together like this. Their brains are weird.
Some kind of a weird trend they got going on.
Well,
This is
it's a
trend,
calculation.
right?
It's a calculation. So remember, it's just
Very
math.
scientific Craigslist-based
Yes,
calculation.
Exactly.
After they drink
Yeah.
Would that be a Estoppel certificate?
What is a Gestapo certificate? I'm so sorry.
Oh, okay. So
I
think
know
Estoppel
that term
certificate
from-
just shows the lease is basically the numbers on the lease.
Mm-hmm.
It's on contract.
Yes, exactly. So there is, I've seen it before. In fact, I've got one in my email right now that a realtor sent me because we were trying to look at some loan programs. But my apologies, I didn't know that it was called that.
Oh, okay, but that's like what we're talking about, basically, right?
We are talking about the appraiser assigning a rent value to what that property could rent
Oh,
out.
okay, so maybe okay.
Yeah. Okay, so in this respect,
Showing.
in this case, even though it's listed at $295, you're going to want to offer them $270 based on the cap rate. Okay. All right. Example number 3. So very similar to what we've seen already, but now we're taking a look at what you should be renting it for. Okay.
How would we get the going cap rate number? We just need to call random appraisers and be
Yeah.
like, hey, in this area, what is the going cap rate in this
It's
neighborhood?
actually published.
Where
So-
would we be able to find it?
Yeah. So let me share with you.
Thank
RPR.
RPR.
Mhm.
Good one.
RPR is a,
Okay.
is a good one.
They really show it.
Hawaii's like 2% average.
So they're published like in the U.S. Cap Rate Survey, CBRE, stuff like that. So, but if you take a look at it, you can definitely figure out what's going on. But for the most part, when you are going for a commercial property, the seller generally would have done an appraisal or has an appraisal from before. You know, when you are working with a residential property, if you don't, as a listing agent, you can look at comps, and if you don't have an appraisal, you can be like, let's list it for $500, okay, or $499 to make it look good.
You technically look at the sales price versus list price, and then that dictates about how much over or under than we would need to advise our client to offer.
Correct.
Scientifically.
Correct, correct. But if you really wanted to be amazing, right, you would have an appraisal done on that property. That way you could, with confidence, know that number one, you're not underlisting it, and then number two, you also know that you are delivering a fair price to him, right? Because regardless of what you tell the seller that you want to list it for, what's he going to say? I want more.
Of course.
They always want more.
I want, my neighbor sold for $4 million. Why are you telling me my house is only $975?
It's like, why do you have 2 less bedrooms and 1 less bathroom and no pooling garage?
Yeah, and there's an elephant sitting on the
And
house.
there's no pool.
And,
And your roof is 30 years old.
and this
Yeah.
dog cage that
Yeah.
you think is worth $4 million, nobody wants that on their property, right?
Yeah,
A gold toilet is only, worth something to the person that bought it, right? Nobody cares about that. All they care about
Nobody
is
wants your
there's
shit
a
to
toilet.
roll.
Total.
Yeah, exactly. So when it comes down to that, that's what before and let's say that you didn't have an appraisal, and let's say that you did list that property, and then the appraisal comes in. What's the worst thing that happens to a
That
seller?
it's way under.
Well, no, that it's way over.
And then they
Right? You listed their property
Yeah.
for $975, and the appraisal came in at 1.1.
They just missed out on 100.
They just
yeah,
lost
$10,000.
$125,000 based upon your calculations. Okay, so that's why. And so now they lost $125,000. What if it's a commercial property and you're talking about millions of dollars? What's the difference between $30 million and $37 million?
7.
Quite a bit of millions.
Yeah.
Okay. So generally, when they are selling a commercial property, they're going to spend the $2,000 or $5,000. Actually, it's like $5,000 or $10,000, but they're going to spend the $5,000 to $7,000 to have an appraisal, because the last thing they want to do is come in $125 million short. They want to make sure that they are fetching as much as they can, and that listing agent is going to order that appraisal because they want to make sure that they're doing the due diligence for their seller. Because same thing, if you had an appraisal done on the property before you listed it, you could be like, hey seller, this is what it is, this is what it is, this is what it is. There's no, we can count on this value. If they believe that they have a premium, they can still offer it for more, because what we seen, even in this market, people are overbidding each other, right? If the property is the right property. So it really just depends on how that works. When it comes down to residential property, it's challenging because as a real estate agent, you don't want to just be out there buying, appraisals at $1,000 a pop, right? But with that being said, when you are going for a real estate commission on a $37 million property,
It could be a
that
tax
buyer
write-off.
is going to, exactly. It can be a tax write-off for the real estate agent, but generally that seller is going to be open to those things. Yeah. So that's generally the way that you figure that out. is you have an appraisal done up front of the commercial property.
Great advice.
Okay, step one. If we look at $250,000 property value and the cap rate is 4%, then the NOI is going to be $10,000. And then step two, if we take the NOI divided by 12, that's going to give us our monthly. And if we take that monthly plus our monthly expenses, then that's going to be the rent that we need to charge in order to break even or make our profit.
But sorry, Jim, I'm a little confused how you got max price that you should be willing to pay.
So that is going to be here. So your net operating income divided by your cap rate is going to tell you how much you need to pay based upon how it's operating. And this repeat. Okay, so this is where you would go to get some of the cap rate resources. Is number one, we talked about appraisers, investability.com, and then I know that we heard another space over here.